Thanks for hopping on, Julieta.
Thank you for having me.
Uh, so we've known each other for a couple of years now. When you were at a more of a startup profile, but you since moved on to a different profile of company, and even before the startup, you had worked in a completely different sector. Would you mind starting to talk just a little bit about your background, your professional career from consulting onward, and just, your experience jumping from different profiles and what you've seen that's different between the three of them?
Sure. So I spent the majority at this point of my career in litigation consulting, and about 50% of the time there I spent doing forensic accounting. So I worked on big data projects, everything from restatements to asset misappropriations for Fortune 100 companies. And then a mix of other things, right? But the point here is that it was heavy data, heavy forensic in nature. So really like digging into like historical accounting and finance records and like building a story. The other 50% of my career I spent doing and quantifying damages for purposes of also litigation. So in the damages world, you're doing a lot of valuation work. So a lot of forecasting, right? So 50% looking at what happened and what could have been done differently to prevent it. And then 50% of the time looking at the future, and so doing like market analysis across industries and figuring out what a business could have looked like but for a certain set of circumstances. So
Mhm.
most of that, I shouldn't say all, but most of that was in the context of litigation. So I like to think that I come into any situation with a risk lens, right? Like I've seen a lot of things.
Going to be ingrained into you at that point.
Yes, well, and I talk about this a lot, right? Like our ultimate deliverable in both cases was really like to be able to tell a story in front of a judge and a jury and say like this is what happened. This is what the damages were, and here's the evidence, right? So there's a lot of compliance that goes along with that. But the other thing that I always tell my team is every time I turn something in, it was like literally I knew that I was going to give it to the other side and that they were going to tear it apart. So there's like
Yeah.
there has to be like a high degree of like integrity in the numbers. So fast forward, and I really believe that all of that served me well when I first joined my first role as a CFO. It was a startup environment, and it was really one where the accounting and finance department had yet to be built up. So that was sort of like the first thing that I had to do, right? And I think that the reason why I had to do that is because in that environment where you have external investors, they want to be able to trust the numbers that are being presented to them. So that becomes really, really important. So again, that was a VC backed company. We were there. I joined when they went through their Series A, and we were able to grow that 4x while I was there, expanded internationally as well. So lots of learning. And now I've recently joined a private equity backed company. So in this case, they bought a platform company, a legacy business that had been around for a number of years and really functioned a lot like a lifestyle business.
From
And
a family.
yeah,
Yeah.
yeah, yeah. And we have a really aggressive growth strategy, both growing the company organically and through M&A.
Okay. What would you say, so you're the CFO now, you were the CFO in your previous role. What do you, I guess, what are the most important things you consider when you're looking at a company's financial strategy? And, how is that different from a startup environment to more of a private equity backed play? And you're in different industries now. So what are you seeing as the differences?
Well, first, let me start with the similarities, right? I think that in order to be successful as the CFO, which to me means I want to be the thought partner to the CEO and the go-to for the board, is that it's obviously more than just presenting the numbers. The numbers are important, and the integrity of the numbers are important, but you really have to have an understanding of what's driving the numbers, both historically and into the future, right? So again, this is where I really think that my background is helpful or serves me well in the role, because I really think that in order to understand where you're going, you also have to understand how you've gotten here. So for me, it becomes more of storytelling, and I think that's really important in the role, both in the VC and in the private equity space. And I just shared this in one of my board meetings, in order to be able to tell the story, you really have to have strong partnerships across the different business units, right? Because if you're speaking in some ways on behalf of them when you're in the boardroom, or when you're having more strategic decisions, you have to know how the information is going to flow down and how it has to be presented, as well, to both the leadership team and the board.
So, obviously situations vary, but the general principle between VC and private equity, regardless, both of them consider cash very important, but VC tends to have a spend the money, and PE tends to have a view of generate the cash. How has that impacted how you manage the company's financial strategy differently in the more PE role compared to a VC role, where I imagine, especially coming off of the Series A, investors don't like seeing profits. They want to see that top line growth.
Yeah. So first, I think that changes both in the VC space and in the PE space. When I first joined the VC backed company, this was in 21, so a very different like economic landscape. And I do agree with you that there was this push from the VCs, to really push that spend in order to, because they wanted to scale at no
Yeah.
cost. And I was in the media industry, right? And that was certainly true there, where, what was said in the industry was that content is king. And so you
Mhm.
want to produce content, and content is expensive. Fast forward, you realize that the consumer is not loyal, and that the consumer, will cancel HBO as soon as Game of Thrones is no longer on HBO, right? And so all of a sudden that becomes really expensive, and we as consumers are even experiencing that, right? Like there was a time where you couldn't watch enough good shows, and now
Mhm.
there just aren't that many because the spend isn't there. So all that trickles down to
Yeah.
the VC level, right? I think that, and I say that based on my experience in the media company, but I also sit on a couple of VC advisory boards, and I think that was generally true, right? There was money, and they wanted to spend it on. Valuations were at all-time high. 2 years later, really that changed, I think, drastically, and I was seeing it from the VC perspective as well, right? They were being a lot more careful with their
Mhm.
capital, and they really wanted at least a roadmap to profitability, and to be able to show more intentional investment. So I think that changed in the VC world as well, but definitely, because there's more of a push for there to be an exit sooner rather than later. um, Cash management is really critical to all decisions. So making sure you have a cash forecast is really important, um, and making sure that you have like a really good business plan for any investment is important. In the private equity space, I think it's also different. I think that and I think it depends on where you are in the market, and including and in terms of timing, right? But in my experience right now, we're buying companies that are profitable as standalone businesses, and because they're profitable as standalone businesses, there's an opportunity to leverage that a
Mhm.
bit more. So I'm in this like really nice position right now, I think, where there is some cash, and because of that, we're able to access more cash, right?
More
And
cash next
so
month than there will be
and
this
so yeah, yes, and so the strategy is really to like ensure that we're making smart investments, that we're going to catch up with the synergy sooner rather than later. And again, because I'm risk averse or always looking at things with the sense of risk, I'm still looking very closely at what these covenants are, and modeling
month.
what happens if there's a turn in any one of the companies.
So one of the questions I do have, you talked about leverage. So, we did work together before when you were at the VC backed company. You guys were exploring the credit markets. You had actually tested the waters before we started working together. We ran a process with you. I guess you guys were, and even now you mentioned leverage. So there was cash behind the company in both instances, cash in the business already from a liquidity perspective. What made you decide to explore the credit markets at that point? And, was it different for that situation, the VC backed company compared to now? What was the thought that management had behind that?
So this is my first private equity backed experience, right? But based on what I know, what I've read, and it's not atypical for there to be a lot more leverage
Yeah.
in the PE space, right? So I think that this sort of has always lived here. That that's I yeah that's part of why private equity is where it is, and it's changed some in the past 25 years or so, but leverage has always been part of the strategy. In the VC space, it's newer, right? It's newer, and I think that um, I think it's true. And for us, the reason we went to it is for two reasons, right? One is that we know that equity is really expensive. So if we're going to get new equity partners, there's additional loss of control for the founders. So that's one, and that's not necessarily financial, right? But then the other one is that it becomes really expensive for the current shareholder. So we did look at a couple of different options, but ultimately it made sense, and where we were in the business, that instead of diluting the current cap table, that if the business could afford it, we should at least explore the options out there. So that's when we did private credit. But even initially, with the first time that we raised, and at the same time, we were able to get a line of credit with a traditional bank and have access to additional capital that way. So I came in and always believed in debt, and and the board supported that as well.
I know it's a different profile of company you're working with now, but you know, effectively you've been looking at the credit markets for, call it, 4 years or so, from that first bank line through the private credit experience, the venture backed, and now. What are you seeing? Has feedback changed at all? Have you had different discussions now than you did before? Obviously, taking into account it's a completely different business model, but how are you seeing the differences from, hey, we just raised a bunch of money, thank you, bank number one, for this line of credit, to now, we're private equity backed and we're trying to acquire more companies?
I still see that there's a lot of opportunity for private credit. I think some of it is regulatory in nature. What I'm seeing that surprises me a little bit is that traditional banks are trying to see how they could partner with private credit so that they could have a piece of that business, right? And it's interesting to see them negotiating on where they sit in the stack, in order to be able to have some participation. What I've also seen in the past few years is that more and more players are entering the private credit market. So there was a point where I saw the growth of, and you can probably speak to this a little bit more. I think the growth is still there. It's slowed down a little bit, but there's still a lot of appetite for private credit.
Yeah. Yeah, we see it a lot. We primarily play with the growth stage market, but especially in the lower middle market, asset heavy and or cash flowing, that's been a very robust industry for the private credit space. Uh, what we've seen is a lot of testing the waters on the more venture lending from private credit firms, and we've seen plenty of firms come in, just as many firms go out, very quickly. Where I think I heard the term at a conference last year, interested versus committed. A lot of firms were interested in it because they saw these good returns, these high enterprise value companies, but as soon as it's tough to take the banker or the cash flow underwriting out of someone's DNA when they're looking at a company with no assets and no cash flow and hoping someone
Mm-hmm.
will buy it for more than it's worth now.
Mm-hmm.
But yeah, I mean, definitely seeing a continued appetite there. I guess one of the things I wanted to ask you too, forgive me, I didn't give you a heads up on this. AI has been a big thing in the finance space. Some winners, some losers. It's been kind of mixed feedback depending on not just the profile person, but literally the individual person has different thoughts and feedback on how it can impact the financial role. What is your thought on if you are using it? How you think finance, CFOs in particular, can leverage it. Have you guys looked into that at all? And what are your thoughts?
So I definitely think I am using it, and I'm using it for some basic things, right? Like what should my controls be? What should my processes be? So it's interesting. I would actually say that when I was at my former company, the VC backed one, there was more, I was using it a bit more in the actual systems, right? Because we were just engaging with different accounting providers and we had the opportunity to test some things that were AI native, where
Yep.
more, more mature companies are with legacy systems that maybe aren't AI native and they have to work around that, right? So there's like,
Yep.
so in simple things, right? And I would say that I almost like took it for granted. Like I'll tell you, like ramp is one of them, right? So
Yep.
I brought in ramp pretty early on at my former company, and it expedites the closing process. Well, here again, legacy lifestyle business, they're doing everything manually, right?
Oh,
So I actually have a call with ramp set up next week. So not super fancy, but definitely in the AI space.
yeah. Yep.
We do, because we are investing in, the investments are different here. We do have some consultants that are helping us with our dashboarding, and so we're leveraging Claude for some of that, and I feel like Claude
Yep.
is like a hot topic right now. So there is a lot of things that we're starting to do more in this business, but it's definitely a big focus of ours right now, so we will be leveraging it. One story that I've shared before, and in a different talk, is that about 6 months ago we were exploring the opportunity to buy a company, and that we were talking about it, and what would the assumptions be, and I remember sitting down to start modeling it, and did it at night because during the day things were crazy. And so then I said, let me just try this. And it was just through Chat GPT. I said, let me just try this. I said, hey, this is the type of company I am. This is the type of company we're looking to purchase with X revenues. And these are like the margin. I was like making it up, right? I was just trying
Yeah.
to optimize really like a line of credit. And I said, and this is the seasonality, and I was asking me really great questions like, okay, so if, would you like me to like layer in debt into it? Just a lot of like really great
Yeah.
questions, right? That I would have had to like, as I'm building, kind of think through, but I was like, yes, of course I want you to do that. Um, and so and I was impressed. And then I said to it, okay, so now I want the model in Excel and I want it to be dynamic. And it's like, here's your model. And I was like, oh my gosh, okay. And so I opened it and it was a hot mess. Like all the links were off. It wasn't
Yeah.
actually working, right? And it was actually like at a bank that I was sharing this story. And this is like a large bank. And one of the analysts came up to me after and said that he's been using it for a very similar thing when they're doing like their
Yeah.
diligence, right? And so again, this is 6 months ago. Just this week, I was with a lot of AI folks actually, because I was at a conference, and apparently Claude has solved for this, right? So
Mhm.
it's only getting better, and it's so scary in some ways, and especially for me, right? And I've had a lot of conversations with other CFOs where we talk about the risk and are you really uploading your data? And the thing is, like, there are ways to still leverage it without necessarily putting your data in. But I do think that we have to do it. Like that we just have to, there's no playbook, there's no manual, unfortunately, because of
Yeah.
the speed that this is going at. But you just have to do it. You just have to try. And there's definitely been some frustrating moments. I was trying to enable Copilot more than anything for some of the analysis that we're doing, and there's
Limited.
yeah. Yes. But honestly, this is like what gives me the okay, so there are these limitations, right? And it will get there. I don't know, just yesterday I actually did make the decision to start using or testing Claude because of some of the limitations and some of what some folks shared at this most recent conference I was in.
Yeah, it is interesting. So the financial industry, as you know, tends to not be the fastest to adopt new technologies, but even to your point, the financial professionals and the banks, which I'm surprised about, have started adopting it more. And you know, I I think, and let me know how you view this. I think someone like with your expertise, experience, all that, I don't think that type of role is at risk, because at a certain point, what's that saying? You need a throat to choke, right? When something goes wrong. There have been for years, even before the AI wave, these fully automated accounting, FP&A, and now CFO platforms. But if it screws up, someone has to be held liable for it. I've talked to plenty of founders who, had the CFO be the reason that a company ran out of cash 6 months early. Also had founders say the CFO is the reason that our company survived in our toughest liquidity crunches. You do need that human face. So I definitely think a finance department could get smaller, but I don't think the CFO role is in danger, or, the expertise I think is going to be required regardless.
Yeah, no, I'm not afraid of the CFO role being obsolete. If anything, the demands are just growing, right?
Yeah.
The expectation that you're going to be able to do more with less. And I don't mean that just in that function, because what you just said is true, right? I was at a CFO dinner not too long ago, and we were going around talking about the size of our team. And I remember this one, and this is like VC space, right? So again, easier to adopt AI native technology. And we were going around saying, how the teams are structured, whether it's, it's in they're utilizing consultants in other countries, like all and what AI tools they're using. But I remember this one gentleman said, "Well, I have 9 people on my team, and now I'm a little embarrassed by it, right? Because there is this expectation, right,
Yeah.
that if you are optimizing the use of your team with the proper tools, then your team doesn't need to be that big, and
Yeah.
they could ideally be doing more, value added, like critical thinking when
Yeah.
I'm analyzing the data. But there's also a lot of talk about the pace of adoption in the function, and that's true as well, right? I mean, you're not going to from one day to another have all of these people who can fully utilize the tools. So I think that
Well,
will take some time. And I'm talking about the team. So reduced team, the adoption, not at the rate that we want it to be, although I do think that will expedite at some point, but it's just been
mhm.
slow. I remember like 2 years, it was like I'm in a room with a bunch of CFOs and they're like, yeah, we're not really using it, right? Like there's like,
Yeah.
how do you bring it on? And now I'm seeing it a little bit more, but the teams don't know how to use it. Again,
Yeah.
I think once it hits like this critical point, it'll be much faster because once we start using it in our daily lives, it's going to
Yeah.
be difficult to think like how could you not be using this for work. And the CFO role, though, going back to it, doing more with less in terms of the function. But I think what I'm seeing is, and it's been actually going on for now a few years, but this whole talk about like a strategic CFO, right?
Yeah.
And so that's really, I'm like, tell me more, right? Because again, I came from consultant VC and I always felt like I had to be a partner to the business. But it's like this notion that maybe before it seemed it was more of a back office function. That's no longer the case.
Yeah.
Just recently in talking to different recruiters, what the term they're using is a CFO plus, right? So what else can the CFO do? What other functions can they be leading, whether that's HR, legal, technology, right?
Yeah, we've worked with plenty of small companies where the CFO and COO were similar roles, or if
Mhm.
not, just one consolidated role.
Yeah, yeah, yeah. So that's what I'm seeing, and I think AI kind of enables that, right? I remember talking to CFOs who had the data science. I think in a lot of the large organizations, like not the Fortune 50, right, but others, like there's going to be like data science really needs to partner either really well or even like report to the finance function.
Yeah, like even some of the things we're doing, our deal operations role it's not going anywhere. It's just getting more sophisticated. Where the woman who leads that function, she's still doing some of the admin related to the back office work, but that's slowly being streamlined. And now she can focus on truly where are there areas to optimize the workflows. Basic things like she no longer is having to prepare call notes before meeting or gather all
Mm-hmm.
the research on a client. That's all streamlined through our own platform at this point. So it is crazy what it can do because with our space, the the more technology is enabled, kind of think about like borrowers and lenders, they're going to get closer and closer. And whether it's an A work or, on the debt side where we focus, we're trying to lean into it more to provide a better service versus, fully streamline it because, I think the more like you talked about the CFO plus role, same thing on our end, there's more capabilities that are expected, do more with less is the big thing there. But yeah, I think it's definitely moving very quickly. And it seems to be I would say every couple months, but it seems to be every month, you do hear more people being like, oh, make a big announcement. Oh, we now fully integrated this. Like the big banks are integrating it, obviously more controlled. But I think a lot of the guardrails are what people are starting to get comfortable with.
Yeah, and in this conference that I was just in, we were talking a lot about the data integrity piece, right? So whether it's for VCs or even in this private equity space that I am, because it's lower middle market, the data integrity isn't there, and so that has to be like the primary focus. But once you get that in place, then I think the tools are just becoming easier to use.
Yep, exactly.
And I'll share one other thing which
Yep.
it surprised me, but it's probably going to become more common. But even like in your space, I remember working with one of the potential lenders, and the way that they wanted to conduct their due diligence was, especially like on the sales side, what they were asking for was raw data. They're like, we want the raw data, right? We don't want you to put together the
Yep.
analysis. We want the raw data, and that raw data, we want to put it through our proprietary tool so that it
Yep.
can help us forecast, right? And so I think companies more and more need to be able to be prepared for that, right?
Yeah.
And yeah.
Yeah, it can
So,
streamline it because, I think at the end of the day, when it comes to major decisions, computers, AI can tell you a million scenarios at almost lightning speed. However, you know how the stakeholders are likely to react. You know how your CEO is likely to
yeah.
receive certain information. So I think that's really important where humans can take all that information and make like that lender did. They take all the information, they can see all the scenarios and have it stress tested given what they know they want to see. But then at the end of the day, they can say, okay, we know this person, we know this company, we've seen how they act, we can make an exception, or we have to hold firm on this. So I think the balance is really important.
Yeah, yeah, I agree with that.
Well, thank you for hopping on. It's always good to catch up with you.
Thank you for having me.
All right, enjoy your weekend.
All right, bye.
See ya.